I speak with a lot of high-income earners who've been told they can't use losses from their real estate to offset their W-2 income under any circumstances. It's some of the worst advice I've ever heard. So I'm about to show you a strategy that might change everything for you. It's called the short-term rental loophole, and it's honestly one of my favorite strategies to help my clients implement. Why? Because it allows those who would never qualify for real estate professional status to still take massive losses from their real estate and offset their W-2 income. It's 100% legal, fully supported by the IRS tax code, and most CPAs have no idea that it exists. So in this video, I'll break down exactly how the short-term rental tax strategy works, how it's different from a traditional long-term rental, who it's best for and who it's not good for, and the specific requirements you need to meet in order to take advantage of this. And just a quick disclaimer, this is educational content only. Make sure that you work with a qualified tax professional to help you with your specific situation. So first, let's talk about why a traditional long-term rental is typically not going to help you being a W-2 employee to generate real estate tax losses to offset your W-2 income. First and foremost, we need to talk about the passive activity loss rules, which came about from the Tax Reform Act of 1986. Ultimately, how this impacts people like you who might be a high-income W-2 employee and using real estate as an investment is it made rental properties by default to be considered passive. Your W-2 income is non-passive. And so the dilemma is that you cannot use rental properties, traditional long-term rentals, that loss, and make it to offset your W-2 income. An exception to that is real estate professional status, which I will talk about in a future video. And the requirements, just in basic form here, just for this video. Number one, you have 750 hours in a real property trade or business, and you also have more than 50% of your time also in a real property trade or business. Now, for full-time W-2 employees, that's basically going to be impossible. Even if you're married and both of you are working full-time, that's just going to be very difficult for most of you to do. Now, the other part to that is you also have to materially participate in the long-term rentals as well. Again, very difficult for most full-time W-2 employees to do, considering that you have a full-time W-2 job, which is going to be about 2,000 hours a year. You would now need to also put in over 2,000 hours a year just into your real estate activities. So let's just assume for the sake of this video to move into the short-term rental, that's just not going to be applicable for you. And again, the frustration is that you might generate a loss from a long-term rental or long-term rentals, but it is going to be passive and therefore cannot offset your W-2 income, which is non-passive. That's the dilemma that we're talking about. But one other exception is the short-term rental tax strategy, and that's what we're going to dive into in just a second. But before we get into that, let me make something really clear. What I'm going to explain in this video is exactly the type of specialized tax planning that I do with my clients. We work with high-income earners, people typically making about $300,000 or roughly in that 24% tax bracket, or higher of course, who specifically want to use real estate tax strategies to minimize their taxes without having to quit their full-time W-2 job just to go full-time into real estate. We can't work with every single person because it does take personalized one-on-one advice and direct access to me. But if you're interested in exploring something like the short-term rental tax strategy or other real estate specific tax strategies and how that might work for your specific situation, click the link in the description to book a call with me. We'll look at your specific circumstances and have an honest conversation about maybe some opportunities that we might be able to explore with you. All right, now let's get back into the strategy. So here's the main difference between long-term traditional rentals and the short-term rentals with the short-term rental tax strategy. The main difference is that the average stay per guest is 7 days or less. Now, that might sound unique, but this is coming from a Treasury regulation under 469, which has all sorts of regulations and code sections about passive activity losses. And some tax gurus out there would have you believe that's all you need to do. But that alone is not going to automatically make this short-term rental to be considered non-passive to then offset your W-2 income. You have to materially participate in the short-term rental, or if you have multiple short-term rentals, plural. What this does, if you have the property with an average stay less than 7 for the full year, and you materially participate in that short-term rental, now that can move what would traditionally be considered passive. Remember, keep that in mind, the passive activity loss rules, and now it's going to move into being non-passive to offset that W-2. you now get the benefits of using those losses that you generate to now offset the W-2, and obviously that might be in combination with a cost segregation study, and this can have massive impact on your tax savings. So let me jump into some specifics about the requirements. Yes, the average stay has to be less than 7 for the calendar year. That is based on the calendar year, and it's based on an average. So yes, you can have stays that are over 7 for the year, but just your average over the course of the tax year has to be 7 days, like 7.0000 or less for the entire year. If someone stays longer, that's fine. Again, just the average stay has to be 7.0000 or less. And if you're wondering if the IRS even looks at decimals, they do. There have been court cases that have shown that they look at decimals to determine more specificity other than just rounding to the nearest day or round number. Okay, now let's talk about the juicy stuff like material participation. What does that mean? What is out there? So first thing to mention, you have 7 material participation tests that have been given to us from the IRS. Now, the 3 most common that I have seen with my clients over the years I've been doing this is number 1, 100 hours and more than anyone else. Okay, now let's talk about this for a little bit. So the 100 hours, think of that as a minimum floor that you need to hit for the calendar year, okay? But then part 2 to that is that you also have to have more than any other individual. So let's talk about that. That includes cleaners, that includes handymen, that includes property managers, or anyone else who's involved in the property itself. Now, one other question I get commonly here is, what if you have a company of people, or say you have a general contractor who hires several subcontractors? Do you look at all of them as a group, or do you look at them individually? And the answer is individually. So that can help you. And even thinking about cleaners, right? If you have one cleaner who helps you for 12 months, that's a very different participation requirement that you might have, unless you were to have, say, 5 different cleaners and all of them had, different amounts over the course of the year. So there is some strategy here. The second one that's very common is the 500-hour test, period. You'll hear, and what I'm trying to emphasize there is that you don't have 500 hours and then more than anyone else. It is simply 500 hours. So if you accumulate 500 hours or more, you then don't have to consider anyone else's time within your short-term rental, which is great. However, you have to get 400 hours at a minimum more than the test that we just walked through with 100 hours and more than anyone else. And then third is the substantially all test. Now, I have rarely of the 3, even though these are the 3 most common, this is probably the least common of the 3 that I've seen, and it is something you have to be careful about because the word substantially all is very subjective. And I think that could be intentional. Now, if you talk to certain people, they might say, 80%, 90%, 70%. It's still a bit subjective, and it's not as clear cut as something like 100 hours and more than anyone else, right? So just be careful on using that one. It is applicable and it can work. Just make sure you have almost all the hours within your specific short-term rental. Okay, so what actually counts for material participation? I break it into 2 primary categories for the sake of this video. Number 1 is the physical work that you're doing on the property. Think of this as going to the property to make improvements or repairs. You might be cleaning the property. You might be buying furniture, putting together furniture, things like that. The second main category is management time, property management time. So this is going to include things like speaking with guests, setting up your Airbnb profile, and things like that. Common question I get here is, if I hire a property manager, does that completely disqualify me? And the answer really depends on what test are you using, such as if you're using the 500-hour test, then who cares if you have a property manager if you're truly getting real material participation time. But if you're using the 100-hour test, you just need to make sure that of all the hours you get, it's more than your property manager, and you've got that kind of floor of 100 hours. What documentation you should keep? So number 1, if you have any stays that go above 7, you want to keep some sort of a booking log that shows the different stays, and then you calculate for the end of the year what was the average and that it was less than 7 days. That's number 1. Number 2, you have a time log, and that is probably the most important documentation that you're going to have if you're going to implement this. Now, a common question I get here is, does this get included into my tax return? The time log documentation itself, no, but obviously you're claiming the short-term rental strategy, and if you ever got audited, they would likely ask for that time log documentation. So keep that time log. You want to show things like what was the date that you worked on the property, You want to have how many hours did you have on each activity. You want to have a description, the qualitative aspect of what you were doing. You want to have who is working on the property. If you have multiple properties, you want to designate which property you are working for. Now, a couple other things here I want to note. Can you rent to the same person repeatedly is a common question I get. The short answer is no, you should not do that. That could be seen as one longer stay, theoretically. So be careful of doing that. Obviously, you want to have different stays to different people, so we don't get any sort of confusion from the IRS and they assume you have one long stay because a certain guest was allowed to stay there over a continuous period of time. Another common question I get is about renting to family or friends. If you're going to rent a family, that could cause issues, especially if they're of lineal descent, such as a grandparent, a parent, a sibling, a child, things like that. Even if they were to pay fair market rent, that's still going to be considered a personal use stay. Now, friends or on a more extended family could be a different situation. And if they pay fair market value, you're likely not going to have as much of an issue. However, just make sure you're not doing anything that could be considered, shady, where you're paying them back or anything like that. And the other big thing you need to be concerned about is personally using the property. If you're going to use the property personally, like stay there for vacation, you're not going to work on the property at all, that's going to be personal use, and that is going to have a negative tax implication for you and being able to take tax deductions against your W-2 income, which is the goal in the first place. I'm not going to go through the specifics on this video. I'll save that for another time. Okay, now who is this strategy really good for? This is really good for high income earners who can't qualify for real estate professional status. It's also good for people who are willing to handle some level of short-term rental property management. And if you want to own high quality vacation rental property in a desirable location, that's great. You also want to make sure that you are open to spending time in this in order to meet material participation. And you want to make sure that you have some risk tolerance to handle the different income fluctuations based on our economy and based on seasonal demands. People who should likely avoid this are people who can't or won't materially participate in the short-term rental. Obviously, properties that have short-term rental restrictions, which is a growing concern, and also anyone who's not willing to deal with higher turnover and management of some level over the short-term rental. Or if you don't have the capital to invest into a high-quality market with high-quality amenities, also not great for anyone who's really only in this for the tax savings. I know that might sound odd coming from a tax strategist, but I have just seen those who do this only for tax savings and aren't really interested in the asset class at all, that in a couple of years they will burn out after they don't see tax savings and basically just sell the property and get out. So please be careful about that. My goal in helping clients, like maybe you, is to think through these long-term implications, tax savings being one of them, but also we need to think through longer-term tax implications as well. Another type of person would be someone who's planning to mostly use this for personal use, like their own vacations, or anyone who's planning to turn this into a long-term rental maybe after the first calendar year. That could be an issue. Another main difference between a traditional long-term rental and a short-term rental is obviously the income potential. I have seen that short-term rentals can generally generate more income as a property at a similar purchase price. Obviously, there's differences in management intensity like we talked about. And if you're still thinking that you're not convinced on a short-term rental, then maybe a long-term rental makes sense. And maybe after you accumulate several long-term rentals, you might consider getting into real estate professional status or eventually selling those and getting into a short-term rental. Or both, right? You have a diversification into multiple different asset classes. Okay, so I've walked you through one of my absolute favorite tax strategies for my high-income earner clients. The short-term rental loophole is so powerful because it gives you access to real estate tax savings that you could not get simply by trying to qualify for real estate professional status. But here's what I need you to understand. This strategy, although I've tried to make them very simple, has specific requirements from the IRS. And if you don't do this correctly, the IRS can reclassify your short-term rental as non-passive and turn it into a passive activity, which means you won't get any sort of tax savings for most situations. I've seen people try to do this on their own and made very costly mistakes doing so. There are also so much more detail here and so many other considerations that I can't put into just this one video, such as entity structuring, state tax implications, maybe local regulations, and just how this overall fits into your holistic tax plan. At Carrier Tax Consulting, I help my clients use this strategy and several other real estate tax planning approaches to get a holistic tax savings both now in the short term and the long term. Can't guarantee specific results because every situation is different, but I can offer you a proactive, one-on-one direct access to me approach where we evaluate every single legal tax approach that's available to you and you're interested in exploring it. If you're making over $300,000 a year and you're tired of paying so much in taxes and you feel like you have no plan of what to do or how to do this, then click the link in the description and book a call with me. We will discuss your situation and what you're looking for and how I might be able to help. Thanks for watching. If you found this valuable, subscribe for more real estate tax strategies like this, and I'll see you on the next video.